Good afternoon, traders and investors alike. Welcome back to Finom Group's weekly State of the Market. I am your host, Seth Golden, and as we usually like to kick things off, here's a pretty thoughtful quote for the week, if you will, from Jesse Livermore. Wall Street never changes. The pockets change, the suckers change, the stocks change, but Wall Street never changes because human nature never changes. Thought that was pretty thoughtful. But it also speaks to, and I want to kind of hammer this point home, Wall Street never changes. The stock market itself, you could add maybe one more thing to this. The stock market never changes because human nature, human behavior never really changes. And that's why we focus on quantitative data as if it's our religion at Finom Group. So with that said, let's dive into some more schools of thought here. And this is something I had, basically been contemplating recently. Two schools of thought. One is technical, one's fundamental. Technicals. This is what a technician might say, if you will. Follow price action, trade the chart, right? You've heard that before, I'm sure. Trade the chart that's in front of you, so on and so forth. Here's what a fundamentalist might say. Nothing has changed but price, right? So in kind of the fundamentalist might take on the view that, just because a stock goes up or goes down, nothing's really taking place here other than a change in price. How does that lend itself to actual capital allocation? How does, following price action lend itself to capital allocation or just holding on to a position, right? The chart breaks down. What does that mean in terms of follow the price action? If a chart breaks down, if the fundamentals, if nothing is really changing but the price, how does that lend itself? Should I add? Should I hold? Should I take profits? Well, really the solution is, to all of that can be summed up in one question. What's your time horizon? That's really all that matters. That could answer both of these questions here. Or contemplations, if you will, the schools of thought. Your time horizon basically, sets in place the answers to all of these questions. You hear technicians go after fundamentalists, fundamentalists go after technicians, and quantitative analysts go after both. But what it really all boils down to is, what's your time horizon? That basically will answer all of your questions, be them technical or fundamental. We came into this week, right? This is the Memorial Day trading week. So kind of as a review, this is what we know based on the quantitative data, history, if you will. S&P 500 weekly returns for Memorial Day trading week. Right here, historically, going back to 1971, the average return for the S&P 500 was about 0.5%, right? The percent positivity rate is 62%. That's above average. So, in that sense, you might have expected a pretty decent week here for the S&P 500, maybe even new all-time highs based on what we came into the week. But if we change our time frames and we look at Memorial Day week since 2010, it's quite the different story. We're actually down 0.6% for the trading week since 2010. And the percent positive for the week changes to below 50%, meaning more often than not, the week is negative for the S&P 500 since 2010. As I often say, the seasonal data should be paired with other quantitative data measures and maybe even a macro perspective. This is gives you a different look at the seasonal data here. The worst 6 months of the year, we're in them, right? May through October. Those are the worst 6 months returns for the S&P 500. If we're just looking at June, since 1950, market returns are positive, but not very much, right? Like less than 0.5% in the month of June. We actually, the past 20 years, the market has been down in June for the S&P 500. Past 10 years, been pretty good. For the whole month of June, not Memorial Day week, the whole month of June. Post-election years, which this is, right? This is post the election year, market returns are negative, down just about 1% there. So different variables give you different outcomes. Past 10 years have been pretty good, which included a post-election year, right? So just keep that in mind. Since 1950, June is the fourth worst month of the year. It has been higher the past 5 years in a row, the longest streak since a stretch of 6 in a row in the late 90s. The past 10 years, though, June was up 1% on average, ranking as the 7th best month. Now, here's another way to, kind of going back 20 years. This table is, every month going back 20 years, the percent positive rate and their total returns by month. And as you can see here, if we go back 20 years, the S&P 500 closed higher than it opened, right? Percent of months in which S&P 500 closed higher than it opened. In the month of June, the average return over 20 years has been negative, but the percent of times that it's closed higher has actually been 60% of the time, which tells you on those down years for the month of June, it's been a pretty sizable drawdown or more than average. What about the Nasdaq, right? What about the Nasdaq, which has been the laggard here year to date? The percent of months in which the Nasdaq closed higher than it opened, going all the way back to 2002, modern era, right? I mean, we could go further back, but the reality is the market has changed very much here in the turn of the century. So if we're looking at, that aspect of things, the Nasdaq, unfortunately, has only closed higher 45% of the time over the last 20-year period. The average return is negative, almost 1% lower. Nasdaq has performed worse than the S&P 500 over the last 20 years for the month of June. But maybe this weakness is a buying opportunity. Look at July, folks. As a matter of fact, all right, we can take another view of this as well. First month of a new quarter for the Nasdaq, pretty good return. Above, it's positive return, and the index is positive 55% of the time. That's the first month of the first quarter. Look at the first month of the second quarter. Positive return 65% of the time for the Nasdaq, 2.5% gain. This is the first month of the third quarter. 2.5% gain, but the positivity rate is almost 80%. So going back to my previous question, this may prove the dip that you buy if we're only looking at the seasonal, quantitative data, if you will. All right, percent of months, another way that we can look at this, right, is comparing the Nasdaq with the S&P 500. The percent of months in which the Nasdaq has outperformed the S&P 500 over the last 20 years. Not very good in June either. Only 35% of the time has the Nasdaq outperformed the S&P 500 dating back to 2000. And again, a negative 0.3%. But again, this may be the dip you buy because look at the first month of the third quarter, positivity rate or outperformance rate, almost 75% of the time, and the gain is 1.2% on average. So a lot of different perspectives, looking at the S&P 500, looking at the Nasdaq, and looking at the relative performance ratio between the two indices on a seasonally adjusted basis. Another way, okay, again, this is the first year of a presidential cycle. The second quarter for the S&P 500 generally produces a positive return. As you can see here, the average return going all the way back to 1950 for the Q2 period in year one of a new presidential cycle, the 2.7% return. Question. So the start of this quarter was April 1st. To date, right? So up to this point, 5.7% gain. That's already well above, what we're looking at here, which is an average of it's 3% above the average return dating back to 1950. We might have already priced this in and then some. So just keep that. Also keep in mind the seasonality for the first quarter, which shows in a first year presidential cycle, we were supposed to get a negative return, but we actually had a pretty strong first quarter return. So it didn't work out this way according to history. So who knows? Keep an open mind, be flexible with your trading regimen and investing approach. This didn't work out. So far this is, and then some. We may get a pullback, back to, a more average level, if you will. Here's where we are year to date. And speaking of the Nasdaq or the Qs versus the Spider, the S&P 500 index ETFs, if you will, we already know that we've got significant underperformance with respect, to the Nasdaq versus the S&P 500 year to date. It doesn't seem to be getting better based on this relative performance ratio. We've recently come off the bottom, but we've made double bottoms here. Or lower lows. We've made lower highs in this performance ratio. That's, the textbook definition of a downtrend. So QQQ versus S&P 500 is in a downtrend. We'll see how this changes as the year progresses as well. But time frames matter. Keep that in mind. Time frames matter. This is a one-year chart. It looks like a period of consolidation, really. If we go back to July of last year, it looks like a long period of consolidation. We made new highs in the relative performance ratio in February of this year, with the Nasdaq making an all-time high. And since then, this relative performance ratio has rolled over. But time frames matter. So just remember, if you are somebody who is inclined to invest in the Nasdaq, who knows that, look, the majority of stocks in the Nasdaq have very good earnings. They, Apple, Microsoft, Adobe, PayPal, Amazon, Google, they're your fan mag names and then some. They have the greatest free cash flow as well. I don't blame people for buying the dips in these areas of the market, even though there's relative underperformance taking place for what seems like a year now. I don't blame you. I don't blame you for, quote unquote, holding that bag, if you will, in Apple, in Facebook, in Amazon for the last several or 2 to 3 quarters now. But time frames matter. And always remember to stay invested, and that the volatility is the price an investor pays for future returns. The risk of investing is really summed up in this chart right here, which goes all the way back to 1980. The S&P 500 has gained 20% or more in 19 years since 1950. In 8 of those 19 years, the S&P 500 fell 10% or more during the year. So you get a gain of 20%, but you got to suffer through at least a 10% drawdown. Volatility is the price an investor pays for future returns. Stick with the market, stay invested. If nothing has changed but the price, maybe that's your opportunity to leverage higher, buy the dip. No pain, no gain, as they say. And speaking of the Nasdaq versus the S&P 500, I asked the question, what are the probabilities the Nasdaq or growth or tech will resume their leadership? So that's why I hinted at timeframes matter. This chart right here is of the Nasdaq, and as you can see, this particular, we made a high in February, made a new, slight high at the end of April. We had this trough 12% correction through March. We had another correction just recently, about an 8% drawdown, but we haven't made lower lows. We've made higher lows. We've yet to make a higher high, but that's why we also have this upward, sloping wedge that's developing. Nasdaq came into today just above the 50-day moving average. This is a 2-year chart. This is a 2-year chart. In the middle of the chart is, growth versus value, right? Because that's been thematic this year. Growth versus value, growth versus the reflation, the reopening, the cyclicals trade. So in the middle panel here of this stacked chart, we have the Russell 1000 versus the Russell 3000, growth versus value. That's why this chart is 2 years. Now look what happened to this, growth outperformed value up and into, this period here of late September of 2020, right? I mean, this is huge move in growth over value. And since that time, it's rolled over where value is outperforming growth. When we look at it from this longer time frame, we can also see this was resistance. It became support, support. That's why I say in the previous chart, this looks like just longer term consolidation. And I asked the question, what are the probabilities that the Nasdaq or growth will resume leadership? If you look at it over a longer time horizon, it's just consolidation. There seems to be an inevitability that tech, growth, the Nasdaq will recapture leadership. It's just a matter of when. We remain open-minded as we have to be mindful that if this breaks down, then it comes into greater question. Are we in a more protracted regime where cyclicals, value, bank stocks, energy stocks, those reflation trades are going to benefit that much more into the future with respect to growth, tech, Nasdaq? The bottom chart is a similar kind of look at things. This is consumer discretionary, i.e. growth. That's a growth area of the market versus consumer staples. Consumer discretionary versus consumer staples along the same time horizon. But as you can see, even this area of growth versus value or risk on versus defensive, because consumer discretionary is more of a risk on market, consumer staples are more of a risk off market, or sector, if you will, area of the market. But this one is also, we've seen tremendous outperformance in consumer discretionary / risk on versus consumer staples, risk off, all the way up into this year, about February, where the Nasdaq also started to correct. But it's been this has also found resistance, became support, still support. It's abiding by the technicals. You look at these 3 charts over a longer time frame, it still suggests that tech is leading. It's just leading a different phase of the new cyclical bull market. It's leading the consolidation portion of a new cyclical bull market. Like cyclicals, financials, and they're not going to go up forever. They're going to consolidate. It's just a matter of when. Back here and back here, I'm sure here, I'm sure people were of the opinion tech is just going to keep going. Growth is just going to keep going. Consumer discretionary is just going to keep going. That's not how the market works. Eventually, you hit a peak and you consolidate. Tech, growth, Nasdaq has begun or is in, well into that consolidation period. And, they're leading that phase of the new cyclical bull market, in my opinion. Some of the things underneath the hood, like while we're seeing this hesitancy for the Nasdaq to get back to it's within 4 or 5% of its all-time highs, and still in this second phase, consolidation phase. We're seeing good things happen underneath the hood of the S&P 500, such as the percent of stocks within the Nasdaq trading above their 50-day moving average has finally gotten above 50%. Even when the Nasdaq made a new all-time high back in April, this particular breadth metric was not above 50%. Coming into today, Thursday, it was at 53+%, the best level since late March. Good things are happening. There are more stocks that are uptrending and above their 50-day moving average in the Nasdaq than there has been since late March. Another, positive development underneath the hood of the Nasdaq, the advanced decline line has broken this, streak here of lower highs. And it's at its best level again since late April, which was better than here in March. So we've seen, even though the Nasdaq's not going anywhere, still just kind of chopping around, moving sideways, there's more advancers than there are decliners within the Nasdaq. Another metric here is the Nasdaq Mcclellan Oscillator, which is an exponential moving average of, or calculation of, exponential moving averages from the advanced decline line. And as you can see, best level since February. Again, thinking about the new all-time highs that were set in the Nasdaq in April, weren't even at this level. Good things are happening underneath the hood of the Nasdaq. The problem with the Nasdaq is it's a cap, just like the S&P 500, they're cap-weighted indices. Apple not going anywhere, the most heavily weighted. Microsoft not going anywhere, the second most heavily weighted. Facebook made a new high, but has since consolidated. Amazon not going anywhere, consolidating, hanging around $3,100, $3,200 for the last few months, not going anywhere. These are, top 5. Tesla's in a nice downtrend. These are the top 5 stocks in the Nasdaq. Rest of the Nasdaq is improved, has improved. Problem is those heavily weighted stocks, they're not going anywhere. It's keeping both the S&P 500 and the Nasdaq under wraps right now. And again, more positive developments underneath the surface of the Nasdaq. This comes from macro charts. You kind of want to caveat this here. This chart above was replicated from Sentiment Trader. I'm not a big fan of macro charts. They steal a lot of Sentiment Traders' works and other people's works. He's a popular Twitter character. I've been blocked by whoever the gentleman is because I've caught him in the act. He stole some of Finom's works in the past and tried to promote them. And so instead of arguing with me and getting into something publicly on Twitter, he decided to block me. But I do trust this particular data because I know it comes from Sentiment Trader. I've seen it. But anyways, this is what it's depicting. The percent of stocks with MACD buy signals has risen to a pretty healthy level, the strongest since March of 2020. MACD buy signals. So keep that in mind. And remember what we had talked about only a few weeks ago. The Nasdaq Daily Sentiment Index had reached the March 4, back here, just recently in May, got back to the March lows. And good things tend to happen for the Nasdaq going forward. as outlined in this study, the Nasdaq 100 DSI, Daily Sentiment Index, falls below 60 for the first time after more than 3 months, well, good things happen. Why do we pay attention to the data? This right here. Below is a chart from March 5th. We issued this chart from bullmarkets.co on March 5th when the Nasdaq was down about 11%, just before the Nasdaq's correction trough on March 8th. It reinforces the importance of relevance of knowing the forward-looking probabilities. This again, percent of stocks with a MACD sell signal. When it gets this high, when the sell signals get this high, you're usually near a bottom. Again, this triggered on March 5th. The Nasdaq's bottom for that correction came at 12% at March 8th. We all know what happened after that. Oh, over the next month and a half, the Nasdaq gained everything back, made a new all-time high on April 28th. So this amount of MACD sells usually is introducing a bottom very near term. And that's why we refer to these kind of data points. All right, so the inflation, you get everybody talking about tech, NASDAQ, growth being long duration instruments, and they don't do as well during a reflation environment, during a cyclical recovery in the economy. All of that is crap. It's just excuses that keep getting drummed up by CNBC, and it just feeds upon itself. It becomes this self-fulfilling prophecy if enough traders and investors believe in it. So here's two charts. To kind of identify what's going on here, because you have to look at it from a different angle. This is a composition of stock markets and economies. So when we think about tech, we know that information technology sector is the biggest part, as the color coding shows you. This is the S&P 500. It's the biggest part of the S&P 500. But when we look for the color coding in the economy, this is the US economy, it is one of the smallest components of the economy. We're talking about reflation. We're talking about a new economic recovery cycle where asset classes are inflating because of the strength of the economy. But information technology doesn't really benefit from it that much. It's a small component in the economy. It's a big component in the S&P 500, small component in the economy. What is a big component? Industrials. What's doing well? Industrials. What's another major component? Consumer goods and services. What has been doing well? Financials, consumer goods and services. Energy is even healthcare. And, these are bigger components of the economy. They do better. It's just a sliver here for information technology. So when things are inflating, you see the consumer price index going higher, right? It's at its hottest level since what, 2009? So we see home prices going up. There's a positive correlation with every part of the market, be it real estate, banks, roads and rails, oil and gas / energy, communications, aerospace and defense, because we know the defense budget has gone up. We know capital goods and expenditures are going up. Energy equipment is going up. These are the correlations with CPI. Meaning these are the things that benefit mostly from inflation. Look where technology is. It's at the bottom, next to automobiles. So it just doesn't get that benefit, the same benefit as other industries, other areas of the economy slash the stock market. Information technology just doesn't benefit that much. So that's why we see, hedge funds and portfolio managers overweighting these industries, underweighting these industries like tech. It's not a matter of, well, their earnings suck or, yields are rising. That has nothing to do with it. It's about what benefits more than other areas. People are looking for yield. They're looking for that reflation trade. But again, I don't blame you if you decide to hold the bag here, holding the bag in Apple, in Microsoft, in Amazon. Like, eventually, those valuations will be too compelling for investors to ignore, as they were in March and before the 13% rally higher to new all-time highs in the Nasdaq. Here, this is from Wells Fargo, Gary Schlossberg. He's their global strategist, and he's doing the same thing. He's speaking in terms of, well, what areas of the market do I want Wells Fargo clients to be in? They downgraded consumer discretionary recently. They downgraded information technology to neutral. They upgraded energy to favorable. Consumer staples to most favorable, which is a bit of an outlier unless they believe we're moving from an early cycle to a mid-cycle stage of the cyclical recovery. Real estate, I can't blame them. It's done phenomenal this year. Maybe taking some chips off the table, rotating it elsewhere, like energy, like financials, favorable. Just in terms of speaking to large caps holding back the indices from making new all-time highs. This is the S&P 500 equal weighted index. So far this year, equal weighted S&P 500 has been outperforming the cap weighted S&P 500 every month this year, except for April. And that was the month that Apple took off, Facebook, all of the FanMag stocks went higher, and the Nasdaq made a new all-time high, the month of April. So far, here in May, once again, equal weight outperformed. What's going to happen in June remains to be seen. All right, the S&P 500 year-to-date through May, when we have more than a 10% gain, which we have. We've had more than an 11% gain, but less than a 15% gain. This study here from Nautilus Research shows the S&P 500 gained double digits through May for just the second time since 2000. Beyond the seasonal trends, the quantitative data suggests investors should not be fearful of the double-digit gains year to date, but rather anticipate more gains the rest of the year. The average after this signal here is an 11.5% gain the rest of the year, which would be like a 23% gain this year for the S&P 500, assuming you're only looking at this particular study or quantitative data. The best part about it, look at the positivity rate. Events up or down, meaning the rest of the year, how many times were we up? How many times were we down? 10 times, we were up. Every single time we were up, if we look at it from this parameter, with these parameters, 100% of the time, the market was higher. Average return, 11.5%. Now, how does that differ from what we talked about last week? The day 100 indicator, right? As of last week, we had 100 trading days in the book. When the S&P 500 index is up greater than 10% year to date on a day 100, the rest of the year historically does really well, an 8.6% return. The difference here is that, some of these were, look at that, 32% higher. 19% higher in 1987, 15+% higher in 1995. So they're not, using this particular parameter, less than 15%. You also might be saying, well, where is 2019? Right? Because it shows up here, 12.7% on day 100, and this is through May, but this was day 100, which only takes us to May 28th. In 2019, right after this day, we started a pretty good correction. And that was predicated, you might remember, the threats to tariff Mexican goods across the border during the whole, trade war saga. And we only finished the month of May up 9.7%. So it failed to qualify in this particular study. That's why it's not there. I've done the legwork, folks. I did it for you. Either way, right? This is a good outcome. This is a good outcome also. The percent positive all years, 70% if you use this particular study. It's still a very good positivity rate. Again, as I often say, just stick with the market, buy dips, stick with the market. But what market? Stock market. Look at the returns. Stocks trounce every other asset class over time. Double-digit returns last 5 years is greater, and greater than cash, commodities, or bonds. No matter what time frame you look at, you're always going to do better in stocks than bonds, cash, or commodities. Stick with the stock market. All right, the infrastructure bill is still in limbo. Everybody's, back and forth. Here's my plan from the GOP, and we'll think about it, says the White House administration and Democratic caucus. The reality is, if it doesn't get done soon, it's not getting done. And that's what basically Data Track has come to. They look at it from President Biden's Gallup approval rating. The current approval rating in May 3rd through May 18th, which was the last poll, was a 54% approval rating. This ties Biden's worst rating to date. His high water mark is 57%, so it's a tight range. Average for all elected presidents. If we look at all elected presidents, the average approval rating for the second quarter in office, going all the way back to 1938, is 60%. So right now, President Biden doesn't have even the average approval rating. For some context, here are the last 4 presidents' May approval ratings during the first year in office. Trump was the worst at 39%. Obama, 65%, which was the best. Bush was at 55%, middle of the road. Clinton was the second worst at 45%. The real issue here, both as regards to an infrastructure package and DC politics in general, is not so much about May 2021 as it is November 2022, mid-cycle elections, midterm elections. History is clear on the fact that presidents with a sub 60% approval ratings tend to see their party lose dozens of House seats in midterm elections. Both parties know this math. Both of them know this, and it deeply informs their thinking about how to either hold on to power or retake it in the Republican sense. At some point, there's got to be a give and take here in the negotiations for the infrastructure bill. There's a lot at stake for the White House administration, for the Democrat Party. There's a lot at stake for the Republican Party as well, if they want to garner favor to recapture those seats. And what is this all leading to? Well, look, you get another round of basically what's going to be economic stimulus. A new infrastructure bill is going to be economically stimulative, you're going to get increased capital goods spending. Now, we're already seeing a huge lift in new orders for capital goods, be them non-defense or ex-aircraft and parts. So there could be that much more if we get an infrastructure bill. But it's got to come sooner than later. If this lasts until August, it's probably not getting done, folks. And that's going to have, ramifications for the White House administration as well as the Democrat Party. Next focus topic is, of course, taper. Sooner or later, the Fed is going to taper. It's coming, folks. We saw in the last Fed minutes that they are talking about establishing a plan. That seems convoluted, but that's where it is. There, in the last minutes we got from the Fed, they're talking about the need to talk about starting to agree to a plan for tapering. The reality is tapering is actually already happening. If we're looking at it from a liquidity perspective, right? Increasing the money supply increases liquidity. That's what quantitative easing essentially does. It increases. Well, technically, you're not really printing money. For all of the Burr comments in social media, for all of the Fed's printing money, commentary and nonsense in social media, the reality is they click a button. There's no genuine circulation of significant new currency, bills, physical currency that takes place. It's mostly a click of a button. And what they're generally doing is swapping reserves with banks for treasury coupons. That's what they're doing. They free up reserves so the banks can lend money out. So essentially what quantitative easing is US dollar funding. It's lending. It's allowing the banks to circulate more money into the economy by way of lending. The reality is, though, you can free up reserves on the bank on the bank's balance sheet to your blue in the face and buy treasury coupons in a swap. That money still isn't circulating into the economy. You can see here in this chart, M2 money supply year-over-year change, right? It just boom, because you have this quantitative easing, which is essentially a swap of reserves for treasury notes. And the banks are supposed to lend it out, which gets back into the consumer hands and goes into the economy, either through business spending or just consumer discretionary purchases. But as you can see, the money to velocity, the M2 money velocity, which tracks that circulating currency, if you will, back into the nothing. It just doesn't work that way. So when people say that the Fed's just printing, well, then show me. Show me where this is actually filtered into the economy. It's not. It's really just clicks of a button and swaps. Now, when we talk about tapering, we're talking about liquidity. But as you can see, the money supply has already been coming down over the last 8-9 months. Like, you get this initial burst from quantitative easing, that lasts a couple quarters, and that's it. And so now you see what's happening with money, M2 money supply. It's coming down, hence liquidity is coming down, hence market is already tapering. Tapering has begun at least 2 quarters ago. It's done the job for the Fed in that sense. Market's been okay, right? Here's Charles Schwab speaking of liquidity. Speaking of liquidity, we expect the Fed to begin telegraphing, not to begin tapering, but to begin telegraphing the first step in normalizing monetary policy, perhaps as soon as the mid-June FOMC meeting, including in the recent release of the minutes of the April FOMC meeting and by several Fed officials since. Discussions are underway about when to start tapering the Fed's balance sheet. Its current $120 billion per month pace of purchases of treasuries and mortgage-backed securities will likely be pared steadily but gradually, given the risk associated with its massive $7 trillion balance sheet. Like was the case in 2013, when the Fed announced a balance sheet tapering and stocks had a taper tantrum, the market could be at risk of a pickup in volatility or a pickup in volatility, a drawdown in the market. So that's Charles Schwab there. So we talked about this last week, the taper tantrum in the sense of the 10-year yields movement. Here was the taper tantrum, if you will, started on May 22nd, and we saw the 10-year yield jump 100 basis points into September. Here's September, jumped 100 basis points from May 22nd to September, 100 basis points. The S&P 500, however, I know I have it here. There's the chart of the S&P 500. From May 21st, I started the chart on May 21st. It bottomed on 624. So basically 2 months later, which seems like a long time nowadays, right? We got to wait 2 months for the market. Like that does seem like a very long time for this particular market. Sorry, I had to clear something from the screen. So don't equate time with how much the market drew down, because the market only drew down 5.59%. That's it. That was the taper tantrum we're all so afraid of. A 5.59% drawdown over a 2-month period. But Seth, we're coming from greater valuations. We're coming from, like a 90% up move from the March 2020 bottom. You can plant trees in front of your, trading success and dip buying regimen to your heart's desire. If you want to make those excuses as to why we could have a bigger drawdown, you're more than welcome to. Plant those trees. Draw fear into your trading regimen if you want. The reality is we don't know. We don't know if it's going to be 5.59%, if it's going to take 2 months, if it will be 10%, or even 15, we have no clue. What we do know is that the multiple has already been compressing on the S&P 500. It dropped just below 21 as of last week because the earnings, the E in the PE multiple, has been climbing faster than the S&P 500. Basically since April, the S&P 500 is stuck also. It hasn't gone anywhere. Today, dropping to 4167 before rebounding intraday to a significant degree back above 4,200. But we're chopping around here. Valuation isn't that extreme. We came into the year with a 23 PE, 2 multiples higher. All right. New record spread between CPI and PPI, because we're going to get more inflation data coming out next week. And, that's going to also play into the Fed's game planning for the tapering process. I mean, look at the spread here between these two. There are ample upward pressures on inflation, at least near term, including base effects, right? We got supply chain disruptions and generally rising demand for goods. Right now, we've got, almost a record level spread between the CPI and the PPI. What happens when you get this kind of a spread? As you can see, the accompanied table above, when the spread has been negative as it is now, here's the 0, and it's down about 5%. We got a negative 5% spread. So we plug that negative spread in here. The forward 6-month returns for the S&P 500 are very muted at 2.3% on average. Again, this is just one data point, but it's something to keep in mind. That's why we say when people are always afraid of inflation in the stock market, the market still goes up. It may just not go up as much as it did prior. When we didn't have such a gap here between CPI and PPI. Here's another table that, because people are afraid of the 1970s and the early 1980s when CPI was high. Look at this, 7.5, almost 7.5% CPI in the 70s, 5% in the 1980s. But the S&P 500 average return in this decade was 17.6%. Average return in the 70s was 5.9%. What people are really afraid of is the real yield, or the real adjusted inflation returns for the S&P 500 are less than the total returns of the S&P 500, because they counter it with the inflation factor. I never quite understood that, because in order to look at it through the inflation adjusted real returns for the S&P 500, you have to believe that here's the real earnings yield, right? And right now, that's what we're looking at on inflation adjusted terms. You have to believe that inflation will be sustained in perpetuity. But there's no probability of that. At some point, the Fed steps in and just raises rates, or does something to stymie the market, to stymie inflation, and you get this grand reset. So what's the point on looking at real earnings yield, which is an inflation adjusted, real return basis? The Fed steps in. The Fed steps in. 1970s, yeah, and even back in the World War II eras, they stepped in the 1940s and put a cap on yields. Just because CPI rises doesn't mean yields are going to follow. As we have seen, the 10-year yield has gone nowhere for almost 3 months now. So do keep that in mind, please, folks. All right, as I always say, buy the dip, stay invested. The market will come around. Market trends higher, goes from the lower left-hand corner to the upper right-hand corner. The two things that you have to overcome as an investor. The two most critical things are fear and limiting your time. The more time you give yourself in a trade and or investment, the less fearful you'll be. How do you give yourself that time? Small positions. Like, no position in your portfolio should be greater than 5%. If you keep your positions light, when they do have a drawdown, it's easier to stomach. Again, I hear it all the time. Don't be a bag holder. You don't want to be a bag holder. You don't want to be the duck that the sellers are feeding. Well, the ducks are still alive. The pigs are the ones that get slaughtered. The ducks don't go extinct. There's nothing wrong with being a bag holder. Remember, in order to take a big drawdown, in order to extrapolate a big profit return, at some point in time, you're going to have to stomach a large drawdown in this particular stock and or ETF. With that being said, I'm Seth Golden. This has been our weekly State of the Market. Tune in next week, folks. We'll see you then.